This one decision can either make or break your financial future. One wrong move, and you could lose tens of thousands, or even your home. But by the end of this video, you'll know how to master the mortgage game in Canada, save massive money, and even pay off your home years early. This is the ultimate guide, and your financial life depends on it. Section 1. What is a mortgage? Let's start from the top. A mortgage is a loan you get from a lender to buy a home. It's secured against the very home you're buying. If you can't pay, the bank takes it. Simple, scary, real. In Canada, most mortgages are amortized over 25 to 30 years, but you don't sign a 25-year contract. No, you get what's called a term, often just 5 years. At the end of that term, you renegotiate, and that's where many people mess up. But don't worry, we'll get to all of that. Section 2, the Canadian mortgage system. Unlike the US, where people lock in 30-year mortgages, in Canada, we play a different game. Here, your amortization period is how long it takes to fully pay off your loan, but your term is how long you commit to a particular rate. Most Canadians choose a 5-year term, even though they have a 25-year amortization. So, every 5 years, you're at the mercy of the market. And rates? They move. A lot. In June 2025, the Bank of Canada cut rates to 2.75%, bringing variable mortgage rates down to 4.9% in most cases. Good news, right? Not if you locked in at 5.7% last year. That's why understanding the next section is absolutely critical. Section 3. Fixed versus variable versus hybrid. A fixed-rate mortgage means your rate doesn't change. You get predictability, but often pay more. Variable rate mortgages? They fluctuate with the prime rate. That means when rates drop, you save. But when they rise, your payment can spike. There's also the hybrid option, some fixed, some variable, like hedging your bets. Sarah locked in a 5-year fixed mortgage at 5.8%. Then rates dropped. Her neighbor went variable at 4.2%. Over 5 years, that difference cost Sarah over $19,000 in interest. Imagine what $19,000 could mean to you. That's a new car. A year of childcare. That's your buffer for emergencies. The mortgage you pick today affects every area of your life. Section 4. Pre-approval and affordability. Before you even house hunt, get pre-approved. Why? Because without it, you're flying blind. Lenders use 2 key ratios, GDS and TDS. That's gross debt service and total debt service. These measure how much of your income goes toward your housing costs and overall debt. And don't forget the OSFE stress test. Even if your rate is 4.5%, you have to qualify at 6.5% or higher. So if you're approved for $600K, your real budget might be $500K. Don't overextend. And remember, the more you put down, the better your chances. Over 20% down? You avoid CMHC insurance. Under that, you'll pay up to 4% in premiums. Section 5. Mortgage insurance and government help. Let's talk insurance. First, there's mortgage default insurance. That protects the lender, not you. You're required to pay it if your down payment is under 20%. Premiums can add tens of thousands to your total cost. Next, mortgage life insurance. If you die, your mortgage is paid off. But be careful. It's often better to get term life insurance separately. And finally, let's not forget the perks. The first-time home buyer incentive gives you up to 10% of the home price as a shared equity loan. The home buyer's plan lets you pull $35K from your RRSP. The new FHSA, First Home Savings Account, combines TFSA and RRSP features, tax-free in, tax-free out. If you're not using these tools, you're leaving money on the table. Section 6. Lenders and rate shopping. Not all lenders are created equal. There are big 6 banks, credit unions, online lenders, mortgage brokers, even private lenders. Banks tend to be safer, but stricter. Brokers can shop around for you. Private lenders? Last resort? Always shop your rate. A 1% difference on a $500K mortgage over 25 years? That's $72,000 in interest. Use rate comparison tools. Negotiate. Ask your bank to match a competitor. And read the fine print. Prepayment penalties, portability, assumptions. These can trap you. Section 7. Paying off early and refinance. Now let's flip the game. How do you pay it off faster? Here are the secrets banks don't want you to know. Accelerated bi-weekly payments. Adds one full extra payment per year. Lump sum prepayments, often allowed up to 15 to 20% annually. Refinancing. Use equity to lock in better rates or reduce amortization. Story. Alex in Vancouver. Alex made an extra $300 payment per month. It shaved 8 years off his mortgage, saved $38,000 in interest. That's power. Section 8. Recap and final thoughts. Let's recap. Know the difference between fixed, variable, and hybrid. Get pre-approved and understand your affordability. Use every incentive and avoid unnecessary insurance. Shop lenders and compare everything. Pay it off faster with smart strategies. This isn't just about buying a house, this is about owning your future. Like this video? Subscribe, share it with someone buying a home, and download our free checklist below. It could save you thousands. Don't make blind decisions with your mortgage. Be informed, be empowered, and take control.